welcome to TheoTrade. This is Don Kaufman. It's January 24th, 2020, and you are watching the TheoTrade Weekend Update. What a difference a trading session can make in the way you feel about the marketplace. I mean, really, this didn't even come down necessarily to the entire trading session. About 4 hours of trade, and now everybody's asking that question. Is this sell-side activity going to be persistent? And that is precisely what we're going to do on this weekend's update. I'm going to look at a couple of sectors. We're going to look at bond markets. We're going to look at volatility. We're even going to look at junk, which we discussed heavily, of course, last weekend, to try to kind of weed out some of the noise of the marketplace. And to me, you know, the discussion of the coronavirus is just that. It's nothing more than noise. It is a catalyst, okay, on the back of what has been just relentless buy-side activity. Nothing more, if you will, than an excuse to see some sell-side. Nevertheless, I am going to display precisely that to you here in the next couple of moments as we jump into a couple of charts and a couple of trade opportunities in all of a sudden what has become, once again, a volatile marketplace. The other aspect worth mentioning right here, right up front, is that last week we saw a crack of the expected move to the upside, a fairly substantial crack to the upside. And this week, once again, and we warned specifically of this, okay, on last weekend's video, we're now seeing a crack to the downside of the expected move. The markets, okay, in effect, are moving from a period of incredible efficiency. We had 23 weeks, people, inside of the expected move. Week after week, we've been watching this. Now 2 weeks in a row that we're actually seeing markets, okay, all over the place, cracking through the downside of the expected move. But push all of that aside for just a moment. If you haven't necessarily looked at the bonds, well, we're about to look at the bonds here because the bonds tell a completely different story than do equity markets, and that is going to be one of the focal points of this weekend's update, because I'm going to tell you right now, those bonds are surely going to be driving a tremendous amount of order flow in the coming week of trade, not to mention the anticipation of movement. People, we are going to be rocking throughout the next week of trade. Just take a look here momentarily at the SPX expected move. With that, let's waste no more time. Let's get right to it. Some charts, a couple of trade ideas. To the charts and trades we go. All right, as I was saying moments ago, what a difference really one trading session can make. And I was kind of further enunciating, you know, really some of the sell side activity didn't kick in until later on in the trading session. We saw acceleration of sell side to the downside and eventually did bounce off of some of those session lows. Nevertheless, you can still see, listen, we're just moments, I mean literally 10 minutes after the market close, and the S&Ps are down about 30. So net, let's just, again, throw this in a little bit of perspective, because I know that, you know, the bears are out there. Listen, I'm one of them, right? The bears are out there, and they're all excited, and we've finally seen some sell side. Yeah, put away the bearish cap just yet, because this didn't even amount to a 1% move. And I wanted to throw that into some perspective. Now, at the same time that I just said that, I'm also going to show you, as you're going to see here in the notes, some serious cracks have actually formed inside of this marketplace. You may or may not see those just yet, but I'm going to point a few of them out. And moreover, again, everybody wants to know, you know, what's this going to look like come Monday morning? Right? A lot of people are going to go through a couple of, thoughts over the weekend over here. This is some dangerous stuff. Will this sell side activity, is this thing going to be persistent? Are we going to open into a very severe, if you will, downside trading session on a Monday? Or are we just going to see more of the norm? What has been the norm? I mean, the norm, look at this. It's not even just about buy the dip. There haven't even been any real dips. I mean, the last time we saw the market even flinch to the downside, you have to go back to December 2nd. And that did kind of pale in comparison to some of the action that we saw in today's trading session. Nevertheless, to have to look back a period of 2 months to see any sell side activity is going to bring even the most bullish of traders right to the brink of sanity over there, because again, some of your worst fears may come alive a little bit this weekend. Let's start to break this down a bit. So first and foremost, I want to take a look at the SPX because, well, first I talked about this last weekend. And last weekend's update, I said, I have, and I'm going to close up this left side bar for just a second here. I have over 3 years of data specifically on the SPX. And one of the things that I can't quantitatively or say this just yet, but one of the things that we've noticed is in markets you go through these periods of just incredible efficiency, and efficiency, okay, is marked, if you will, by staying inside of the expected move week after week after week after week. We just went through a period that net we had about 23 weeks inside of the expected move. And then lo and behold, and I actually mentioned this on last weekend's video, we cracked to the upside and here we are. Now we're just mildly outside the expected move. The expected move, okay, and I just want to highlight this very definitively, was pretty much spot on 3,300. That was the lower edge of the expected move, okay? Another aspect worth mentioning is I had said on Wednesday night, we fully anticipated us to ride right into the edge of the expected move. But at that point, again on Wednesday night, we didn't know if that was going to be higher or lower. And I don't mind saying that. I mean, it was just a cautionary tale that you should be a buyer of options premium, not a seller of options premium. Quite ironically, even a straddle would have worked out beautifully had you had purchased it on Wednesday and or Thursday, okay, even Friday morning, because nobody saw this sell side activity about to occur. So yes, this is technically a breach of expected move to the downside, though minimal, okay, it's one, that's going to count. And I'll show you that here in just a moment. So this past week of trade, and it was a 4-day trading week, we only had, okay, right around a $30 expected move. And again, that's what I was just detailing here moments ago, was this, zoom into it a little bit, this $30 move higher, $30 move lower. Okay, evidently we moved $30 literally today on the SPX. Again, 23 weeks with no breach, now 2 consecutive weeks with major breaches. There's some cracks that are absolutely forming. It does appear that we're moving from this period of incredible efficiency, okay, to what is, I like to call Mr. Toad's wild ride. And that's when, you have to recognize what we're saying here. When I talk about efficiency versus inefficiency, right, it has everything to do with the expected move, but you have to break this down for a second. Look, the expected move, right, for the next week of trade, that's this coming week, which is a full 5 days, okay, that's going to end right here, okay, end of the month. End of the month is January 31st. Okay, that full 5 days of trade is now going to carry about $51.70, okay, of expected move. Now that's all, okay, based on the option premium in this chain. It's just an average of the option premiums in the chain. So you're expecting this $51 move. Now imagine, if you will, okay, and there are billions of dollars being traded 7 days out from now. And if you don't believe that, just go look here at option statistics, okay. The SPX today traded 1.8 million contracts. That's awe-inspiring. It's 1.8 million contracts of a $3,300 product. That's a monstrosity and a half. When you start looking at the 7-day options, check this out. Look at the volume and open interest, okay? It's nothing less than monumental. I mean, there are tens of thousands of contracts being traded in the SPX weekly options now, way out of the money. So when I talk about a period of efficiency or inefficiency, and look at this, by the way, they just pumped a little bit more volatility in here as we're coming into the closing seconds, right? So we're closer to $52. Now, you think about this, there are billions of dollars that say that we're supposed to land inside of a $52 move. When we start moving outside of it, okay, everybody's getting it wrong, meaning that all the market making firms, the entire marketplace becomes completely, okay, displaced. No one knows what option premium should kind of be. And I stress to you, that's why I'm saying the marketplace kind of becomes Mr. Toad's wild ride, because once you start cracking outside these expected moves, no one cares at that point. It's a complete and total free-for-all, okay? And that's why I mark this with this term efficiency and inefficiency. And that is part of the answer to, will this selling persist, okay? Well, they expanded out the expected move, and now we're looking at like a $52 move. You better watch that $52 move, and you better watch it carefully in this next week of trade because it's going to make all the difference. Now, I want to move right beyond the SPX expected move. Although important, it's not everything. Just a quick shout out. Bullish traders. If you're hedged, great. If you're not, okay, you're at the mercy of the marketplace. That's all I'm going to say on that front. I don't know what we're going to be looking at coming into to Monday morning. Yeah, maybe we try to buy the dip. But again, if some sellers start to emerge right now, in terms of hedging, the only chance you have to hedge right now is you're probably going to have to go to the futures contracts or micro contracts to hedge. And that is, if you have bullish positions on and you need a downside hedge, you're probably going to have to sell a couple of futures contracts to mitigate existing risk. Because don't tell me right now that you're going to run into the options market, right? Because if you run into the options market, I mean, listen, you've just seen some sell side activity, right? There it is, starting to show up on the old screen over there. When you can see it in this kind of bullish kind of run, and you can start to see sell side activity showing up on the screen, yeah, everybody else sees it too. And guess what? The option premiums, they're going to be jacked up. Now, the option premiums are not extreme, but if you don't have your hedges on, you're basically at risk. Now, as I was saying also a moment ago, the coronavirus, to me, it's a catalyst to a very dangerous marketplace. And I want to reiterate again here in the spiders. We'll come back to the spiders or the SPX, whatever does it for you. Listen, you could look at every technical study that you want to look at, right? Every technical study. I just want to show this, okay? This is the TheoTrade RSI Laguerre, okay? It's a Laguerre time polynomial, and there's some fractal energy down over here. Guess what? We've been overbought. We've been overbought pretty much since the rally began. And here, the fractal energy is kind of running out. This shows a sell indicator. I don't care how many indicators you pull up, all right? It's going to show that there's some, well, sell side activity over here. All I'm saying is that we were overbought. Okay. And again, the catalyst could have been anything. The irony is, again, I don't put much weight into the coronavirus right now other than a little bit of a fear factor. This is not, okay, to me, like, and I'll stress this for just one moment. This is not to me like 2014. And for those of you do not remember 2014, in the 2014 timeframe, I'll zoom specifically into it. There was a 10% sell-off, and that was due to the Ebola outbreak. This is not per se the Ebola outbreak. Nevertheless, it's just enough to kind of derail, if you will, the markets, okay, to a brief degree. But the reason I'm really getting into this is not to argue, the coronavirus in any stretch of the imagination, and not to even form an opinion on it. It's just to mention to you, okay, that you were already in a wild situation to the upside. And no matter what you might think about this, maybe the virus does, cause a widespread panic out there, even a pandemic. Nevertheless, okay, we were already in this situation, and at times like this, the market hunts for catalysts. This just happened to be along the lines of that catalyst over there. Now, let's move right on to what I would actually term some much more important aspects. And then volatility made a move, but we ain't home yet. We need to take a deeper look into volatility, okay, as a whole. Now, I like to look a lot at volatility futures. Obviously, the volatility futures got bid up, but looking at the volatility futures, like looking at one contract, that doesn't mean squat. It really doesn't. What I want you to tune into is, I'm going to show you. It's simply this. Take a look at the 26-day volatility future, okay? Today, it was up, but it was up almost a full point. It's all the way to 1602. Now, if you go a little bit further out in time, the contract that matters is right here, okay? That's your March contract. So I'm looking at Feb versus March. Again, Feb versus March, 26-day versus 54-day. And what we've got right now, we still have, okay, very normalized volatility skew. That is, the Feb, okay, is still at what? 1602, and the March is at 1623, but boy, have they tightened up a lot, right? That's again, what we talk about with contango and backwardation. What would cause me to say like, yeah, volatility made a move. But when I say we ain't home yet, when I'm saying that, I simply mean when the 26-day volatility starts to exceed the 54-day volatility, then the proverbial sell side crap is hitting the fan. And I suggest to you that, again, when the market reopens, even if we open with buy side activity and then you start to see some sellers, okay, you better watch this spread carefully, because what is often missed about the marketplace, the moment, okay, that these two little monkeys invert, the moment that, instead of this being 1602, let's say that goes up to 17, right? Okay, and the back month sits at like, let's say 1670, okay? Once this inverts, it changes the nature of how, okay, algorithms and firms are even going to trade into the S&P futures. And if you're missing that, again, that's why I say volatility made a move, but everybody right now is like, well, the VIX, and who cares? It doesn't make a difference. The VIX is nothing more than an equation to the SPX, okay? It's an equation to the SPX puts, okay? But really, traders are out there trading that volatility. And more importantly, they're actually trading front and back month volatility. They're trading, this 16 versus the 1623. And when that thing inverts, the only way for them to hedge is to actually sell S&P futures. Think about that. One other quick note in volatility, go to the bottom of your screen, to the bottom of my screen anyway, is VVIX. That's the volatility of the volatility index. It did make a move, okay? And it actually cracked over 100 briefly. Now, what's interesting about this is 100, that kind of, that's that line where we say, all right, now we're going to start to pay attention. We cracked over it for a couple of seconds, but we still pulled in. We're at 98 and change. Believe me, we're all well aware and we're paying attention right now, okay? But the VVIX, the volatility index, tells us, okay, is the professional world running for duck and cover? Well, they've started to, okay? But again, it's not a huge concern. The VIX did trade about 756,000 contracts today, which is huge. That's big size. That's some really big size. You start to think about it. You saw the SPX traded, 1.8 million. The VIX traded, 756,000. Okay. The spiders, let's go to the spiders. The spiders are good for a cool 5 million. You got to recognize the entire market only does about 25 million contracts in a trading session like this. So out of 25 million contracts, you mean to tell me, okay, that almost 8 million of them are directed almost purely at the SPX? Yes, that's exactly what I'm saying. Why do you think we pay attention to the expected move? Like nothing else matters these days. The only thing, like there's all this concentration of liquidity out there. That's why we pay attention to this stuff. So volatility made a move. It's edgy at this point. But when the marketplace does reopen, keep an eye on those volatility futures. All right, now we're going to start to get to some really important topics. Bonds, they're a rockin'. If bonds are a gauge of fear, like, because people use stuff like, I'm going to look at the VIX. But if bonds, and now we're going to pull up these bonds, if these are a gauge of fear, okay, then this week, and this week alone, you should be hiding inside of a cave. Because look, this was a 4-day trading week, okay? That, people, is a monumental move up inside of the bonds. You can look at a whole lot of weeks, and a whole lot of weeks that have a whole lot of risk, but this crap got serious, and it got serious in a hurry. So as the bonds are rallying, all right, we need to see, like, is this it? Did it just break out to the upside? I kind of feel, looking at this, somewhere right around this 160 level, I kind of feel that they have already made that breakout, but they start to break above that 161 level, we could just explode to the upside, which actually brings up the next topic of conversation, and that's going to be TNX. And TNX, okay, that, people, is none other than the 10-year Treasury Index. And I just want to highlight the 10-year Treasury because I've been barking about this incessantly on these videos, day in, week out. I mean, you name it, day in, day out, constantly on TheoTrade chat. I fully anticipate this 10-year right here coming right back down to 1.6%. And with that, okay, is going to be fear again, and it's fear of the yield curve inverting. And once again, I'm going to bring that up over here. I know this is like a hideous thing to look at, but it's the U.S. Department of the Treasury. So Secretary Munchkin, Mnuchin, whatever you want to call him, if you take a look, this happens to be, and again, I might be able to refresh this and actually even get today's data on here because we literally just closed, right? Yeah, we got today's data. Sweet. Okay. What you guys are looking at right now, this happens to be effectively the yield curve, right? And this was today's trading session. So I just wanted to show you, there's the 10-year, which actually closed right at like 1.7%. And everybody's going to be comparing it to the 2-year. So the 2 and the 10. All right. Okay. They still got a ways. One's 1.5%, one's 1.7%. Do you think that conversation is not going to start to happen? Because all the 10-year has to do is come down very, very minimally. Then all of a sudden everybody starts talking about the yield curve is going to invert again. And if the yield curve inverts, that means a recession is coming in. All of a sudden, one trading day, okay, where we have a downside to the marketplace, yield curve inversion will again become a topic. Think about that. With the yield curve inversion becoming a topic, with everything that you see on the screen today, it's also, now it's time to talk about the financials because that's been our primary focus, okay? And today, you're going to see exactly why. The financials made a bit more of a move to the downside. The other aspect about the financials, okay, is if you start looking at the financials, they got whacked. I mean, pretty good today. They're actually down, though, and this is something that maybe you hadn't seen, okay? This is the year-to-date. Now, we're already down 2.2% on a year-to-date basis. Makes sense, though, because the bonds have been rallying here, right? But the other aspect that really resonates with me is if you take a look at expected moves, right? The financials have been efficient. All of a sudden, they cracked, okay? Today, those financials are hideously outside the expected move to the downside. And to me, again, that's more than a shot across the bow, and then answering, will the selling persist? Based on the financials, based on where the bonds are, it's saying, oh yeah, I mean, this thing is, it's ugly. It's the beginning of ugly. But I want to further that for a second. Now, again, do I have a little bit of a bearish tilt to my own positions? Unequivocally, yes. Okay. Nevertheless, all right, you're seeing why I have a bit of a bearish tilt. Okay. Last but not least, we got to go to junk. This is HYG. Listen, I made a really big deal about this specific product on last weekend's video. If you missed it, I'm telling you, watch it. I told you last week they were buying junk like what? Like it wasn't junk? They're buying junk like it was a party, okay? And you weren't necessarily invited. Well, we're all over this trade. And this got ugly today, okay? Junk, all of a sudden, sell side activity. Critical coming into next week. The other aspect that I was mentioning in last week's video is XLU. XLU. We saw this breakout to the upside, okay? It continued, this wicked breakout to the upside. This hunt for yield is on right now, and it just followed through. I'm not looking for sell-side activity in XLU, quite the opposite. They're buying it, and they're buying it, okay, just like they're buying bonds. And now they're all of a sudden turning around and selling junk. Things are starting to make a lot more sense right now. This, to me, looks like an incredibly defensive position. It's an allocation and saying, get out of the S&Ps, go to wherever has yield. What has yield? Utilities have yield at about 3%. I'll buy whatever it is at whatever price as long, okay, as I am away from the marketplace right now. Now, again, that's a lot to kind of gather, both junk and utilities over there. Junk, that's junk bonds, pure panic to be able to get out of them. At the same time, that panic is being met by buying inside of the utilities, right? The financials cracked outside the expected move. We have 2 weeks, the SPX outside the expected move. But last but not least, Apple, totally unscathed, okay? Net, you look at all the sell side activity. Again, what a difference a couple of hours can make. Nevertheless, okay, unscathed. Completely unscathed. Now, Apple saw some serious sell side coming towards the close. If you missed this, you missed a lot of the trading session because right into the cash close, this is the stock that actually took us down. This thing was positive until about 20 minutes to go into the cash session. It was actually positive on the trading day, but there are some big time tech stocks that are unscathed. Net, the monsters of tech, they're only down 0.9%. Again, a marketplace rather unscathed, some sell side activity. If you have your hedges on, phenomenal. If you don't, you could actually absorb quite a bit of pain. Again, how we open on Monday. Be very, very cautious. This is something that I don't typically mention, but I say how we open on Monday. If we open up and we start to see some sell side activity over there, okay, expect that that is real. Again, if we open higher and immediately start to see some sell side activity in there, expect that that is real. I will talk you through that coming into Monday morning. Again, Monday morning live in the TheoTrade chat room. Have a wonderful weekend, everybody. Bye-bye.